Everybody, and welcome to Selfwealth Live, our technical analysis edition for this week here in the home studios of ourselves here. Jason, how are you today?
Hi, Rog. I'm good. I'm good. Looking forward to another show talking about charts. Looking forward to a few stock codes from the viewers. I think we should have an interesting show going forward into today.
Coming up, fantastic. Now, if you haven't noticed, Jason's got an amazing painting behind him right there, and mine I've taken down. Just so everyone knows, I'm moving houses very soon. So in the process, there's absolute disaster zone in my studio at the moment, Jason. It's nice to see you keep your room nice and clean there, mate, with a lovely painting behind you.
Yeah, it's a small snapshot of a wider scene, which may not always depict what you see directly behind me. Yeah. But we do our best to provide a backdrop.
Fair enough. Well, I just thought I'd mention that because earlier in the year we talked about the paintings and we got people to vote on which one the painting is. So in the new place when I'm moving in, I'm going to have to try and beat the painting that you've got there. All right. I'm just going to let you know that I'm looking out for an even better painting because I think you won that competition. Anyway, let's move on to business. Welcome everybody on the live chat side there, on the other side of the computers. Thanks for coming once again and visiting us. Looking forward to hopefully going through some great tickers this week and getting some analysis, and especially around the markets in general. I think let's get straight into it without further ado. Last few weeks we've been going quite a lot overtime, so once again I want to thank you once again for coming for the tickers and bringing us the tickers, which is great. We might put a cutoff at around 1:45. If anyone comes in after 11:45, we'll probably stop it there. 1:45, sorry. And that is obviously Melbourne, Sydney time. If you're in another part of Australia, it's going to change. So 1:45. If anything comes in after that, we'll probably, if we've got the time, we'll get onto it. If not, we'll skip after that. Otherwise, Jason, how are the markets in Australia looking at the moment?
Okay, well, let's start with quickly our disclaimer before we go on. So everything today, general commentary only, no personal advice in any of this. And I'll quickly put up our disclaimer. That just goes through that. And also just remember, I'm not part of Selfwealth. I'm from Motion Trader. That's my business. And you see my details at the top with licensing, etc. And the same for Selfwealth just below that. That's all our general commentary information in there. Now, having done that, we'll go out of those charts. So we'll start off with our ASX 200 chart, and so we've got the ASX 200. This series of all-time highs continued into last Thursday. So last Thursday, a new all-time high for the ASX 200. Bit of a pullback in the last few days, but nonetheless, this series of all-time highs has really been playing out since you go back to January, February. We've had this nice series throughout the year, and that's been continuing. Of course, it hasn't been straight upwards in a nice linear fashion. There've always been those periods of consolidation. And you can see each time the market gets to new highs, the consolidations follow. It's just part of how these markets work. The longest period was this stretch between April and July. Quite a bit of sideways price action along the moving averages. And then some have been short and sharp like we had in August. But it's again, it's just part of how these markets ratchet their way higher with these pullbacks in between. And it looks like we have another consolidation developing now. Just over the last few days, prices are starting to make their way back towards the moving averages. And what consolidations do, they allow the market to basically consolidate those earlier gains. Get these rising periods, and then we get the consolidation or pullback, rising and then consolidation and pullback. It's the ebb and flow of moving higher. And generally, I think we should be looking at pullbacks as being a positive thing. I think it's good when the market pauses to consolidate, because what it does, it helps make an upward trend more sustainable. And it's when markets really take off and they don't pause. That's when they can become unstable and prone to those larger pullbacks. And I think the other thing worth noting is that we've been seeing strength in two key sectors. This is over the last 4 weeks at least. And I just quickly have a look at those two sectors. So they are the financials and the materials. So firstly, let's have a quick look at the financial index. This is actually an ETF. It's the BetaShares ASX 200 Financials ETF, which looks pretty much the same as what the index does. What's interesting with this is that, well, financials have been an uptrend all year. They broke higher in last December. They've had this lovely upward trend. They periodically pull back towards the 50 and 100-day moving average region. And the latest one was in October, came back in the moving average region, and then we've got that nice rally out of it. And so this cycle of rally, buy the dip, rally, buy the dip, it's been continuing throughout the year. So this remains in an upward trend. It's nice rally in recent last few weeks. Maybe we can get a pause here, bit of consolidation, but the upward trend remains in place. The other key part of the ASX is the materials index. And so the BHP is the largest in the materials index, contains a lot of the resource stocks. And this is quite a different setup to what we see when we look at the financials, in that the materials for much of this year has been a drag. It's basically been a drag on the ASX 200 and spent most of its time below these moving averages. We've got our 50 and 100-day moving averages. And you can see for much of this year, not entirely the entire year, but for much of it, it's been below these declining moving averages. The important thing we've seen in the last month is that the materials index has gone from being below declining moving averages to above moving averages, which are now turning higher. So this is a potential important trend change in what is one of the large parts of the ASX. What we're seeing in the last couple of weeks, we're getting this pullback, and this is classic of a market that goes from below its moving averages to above. It's just a classic move where you then get the pullback towards the averages. And what's important here, if the materials can stabilize near the moving averages, establish a bit of a base, maybe around not too far from current levels, that could then set the materials up for a rally going into maybe the end of the year, maybe into the new year, and that's something which could help drive further gains in the ASX 200. So I think it's a really important thing to watch how the materials is playing out. One more chart I want to show you while we're talking about the ASX 200, Rog, is the equal weight. You know, I like looking at the equal weight a bit. We look at it a bit. What I like about the equal weight is that it's exactly as it sounds. It's ranking each stock equally. So BHP is having the same impact as stock number 200. And so I think it gives us a really good indication of the health of the underlying, of the market overall, rather than just being so heavily influenced by BHP and CBA and a few of the other big stocks. So on last week, it was Thursday, the equal weight got within a whisker of its all-time high. All-time high was back over here in December 2021. And so that was about, what was that? That was, coming up to 3 years ago. Didn't quite get there, but very close. I think the key takeaway here is that the strength we're seeing in the equal weight, I think it shows us that there's broad participation in the rally that we're seeing in the ASX 200. So it's not just a few big stocks pulling the index higher. To get the equal weight rallying, you got to get a lot of stocks participating, and I think that's a good thing, because participation is a key driver of a healthy market. Now we'll just come back to the ASX 200. Always room for consolidations with these markets. We shouldn't expect that the market's going to be up each week or each month. when we get a few weeks or get a month or two where we get strong gains, we quickly get conditioned to think, well, this is normal. Markets are up. Look at your account. You want to see green. You get disappointed when you see red. But remember, the consolidations and the pullbacks are all part of it. And so this is what it looks like we're seeing a bit of now. There's going to be those periods like April through to June, July, where markets go sideways. And that's all part of it as well. But I think when we look at this, when we step back, we look at this overall trend from last year and even going back to the year prior. Well, I think when we look at it all, I think the overall structure is bullish, particularly since last year, where we have these rising moving averages and price is mostly staying above the rising moving averages. So that, by definition, is a bullish market. I think the play continues to be approaching this from the long side. That's what I'm doing with my portfolio. I'm using those wide trailing stops I often talk about. So a wide trailing stop will be a good distance below the current price action. So it gives the market plenty of room to consolidate and hopefully see off pullbacks. But of course, when conditions do change, a trailing stop will ultimately get you out of the market or get you out of a stock. And that's how we protect capital when markets do peak and come back. But at this point, I think the benefit of the doubt still goes to trying to stay with the trend, trying to stay long stocks.
Yeah, it's good. I'm glad that you bring up multiple charts and multiple angles, actually, multiple sectors, and see what's doing what. You can't help but think that the financials are driven by interest rates, higher interest rates. You wonder what's going to happen there when interest rates might come down, if that's going to change that a little bit. But it's good to have that comparison and show what might be driving not only the sectors, but having the people to be able to see that it's not just the top 200 companies driving that bullish run. It's all the it's the Australian, all the small caps and mid caps probably coming in and getting a lot of money behind them as well, right? So it's a great to have you compare all those different charts there, Jason, not just the one. It's fantastic. Let's have a look at the American. I'm assuming it's a very similar picture. American market.
Yeah, so the S&P 500, we'll jump over here. This is the S&P 500, and it had a new all-time high last week as well. So it was on Friday. The S&P made its new all-time high, despite some of the nervousness around this year's rally. So this year's rally, there has been a lot of some of the sites I look at, there has been nervousness around the rally, but despite that, the rally's continued and it remains a bullish trend. As I usually do, I've got the 50 and the 100-day moving averages. They're continuing to trend higher, and price remains above the moving averages. So that's your basic position for your basic definition of an uptrend: rising moving averages and price above those moving averages. So that's an uptrend. Often there's a temptation within an uptrend to look for tops, and that's been the case since I got into the market back in the early 1990s. Like, people like to look for tops, like to preempt when's the market going to peak, and because of course, if you can get out at the top, you're better off than waiting for a trailing stop to trigger maybe sometime later on. But the problem is we don't know where those tops are going to be. So more often than not, I find the best course of action, it's actually resisting the urge to try and pick tops and try and outsmart the market and just simply go with the trend. And that's because these uptrends, and as we can see with this one here, for 2 years, these uptrends they typically last for longer and travel further than many people expect. And maybe it doesn't go up tomorrow, maybe it doesn't go up next week or even next month, but as you can see, these trends are powerful forces that can last quite a bit longer, as I say, than a lot of people anticipate. Same applies when we look at the equal weights. We looked at the equal weight for the ASX. The American market has its own equal weight, so coming along across and having a look at that. And very much the same thing applies. We've got this series of higher highs throughout the year. So, or new all-time highs, actually, I should say. So new all-time highs throughout the year. We've got this whole series of them as we go through the months. And as with the ASX 200, we've had these temporary pauses and pullbacks along the way. Nothing here at this point suggests that this trend is ending. Now, of course, a trend is going to end at some point and it will peak at its highs. Of course, that's just how it's going to work. But you can really only join those dots in hindsight. If you're trying to guess at a top at every corner, it's chances are you're going to be getting it wrong more times than you're getting it right. So I think the path of least resistance is simply going with the trend. Nothing here is suggesting that this is currently ending. I think a key detail that new highs in the equal weight tell us, just like I was saying with the ASX 200, I think it's showing that there's broad-based participation in this rally. And that's important, as healthy bull markets have got broad participation and they're not just driven by a narrow group of stocks. I'll show you I'll show you what I think is the most impressive of the US indices as far as a chart goes. And that is that's with the Dow. And now the Dow's often overlooked, I think, in favor of the S&P 500 these days, but it shouldn't be ignored. I think it's an important index which really can give us some good information around the underlying market structure. When we look at this, it's really got this, I think it's got this really nicely formed series of higher lows and higher highs throughout the year. It's also got those rising moving averages, the 50 and 100-day moving averages. They're rising, prices above the moving averages. So this is what a bull market's all about. The other interesting thing with the Dow is that it's not dominated by tech. So the S&P 500, the biggest three companies are tech. You got Apple, Microsoft, and Nvidia. That's not the case with the Dow. Tech does not dominate. It's a collection of big companies from a range of industries. So I think that tells us that the overall market strength, it's not just about AI, it's not just about technology. They're a big part of it, but it's not the only part of it. And I think, this broad ranging rally is something which is being underpinned by a range of industries, not just one.
Yeah, and I've had a few conversations with clients lately about them thinking that it's only a matter of time before something happens. There's going to be a big crash, but at the same time, in the same breath, they're also telling me they've been thinking that for quite a while, and they're kicking themselves for not getting in earlier, right? So not getting in this rally. Earlier. So the beauty, I think, once again, of what we're sort of teaching is that even if you are getting in at the top here, you as active investors, because if you're a passive investor on this show and you're looking just to dollar cost average for the rest of your life, then you might not even think about these. But if you're an active investor, to be able to protect your capital if you're going to get in the top is one of the most important things, isn't it, Jason?
Look, I think there's going to be another crash. No doubt about it, but when? I don't know when. It could be on the horizon, or it could be years away. We don't know. No one knows. So it's I think a mistake people make is just going back to the ASX 200, is that they when we do get a crash, and crashes don't happen that often. They typically don't happen a few years apart. They tend to be more often like a decade apart. So we've had a big crash only in the last 4 years. So you go back through history and you look at the big crashes, you see they're generally not that close. But what was interesting, we had the crash during COVID, and then as the market started to rally, people would tell me, they'd say, look, I like the motion trader service you offer, but I'll consider coming in after the crash. and it'd be like, well, what crash do you mean? The market has already crashed. And it'd be like, oh no, there's going to be another crash. And so, and this happens after the GFC, it happened after the .com. It happens every single time that people look through the rearview mirror of the recent past, and they look for that to continue into the future, particularly around market weakness. So as the market started to recover, we started getting all the buy signals started coming back in through Motion Trader, because I'm looking at the moving averages, I'm looking at breakouts. The momentum was coming back into stocks, but so many people were sitting on the sidelines saying, oh no, I'm waiting because the market's going to crash again and then I can get in. But of course, the market keeps rising, as we know when we look back. And a lot of people stay in the sidelines, sometimes for years, waiting for their view of a crash to play out. I'm sure there's still people sitting in cash from after COVID saying, no, this isn't right. This market's going to come down, and it most certainly will at some point. But at what level does it come down from? Does the market end up getting to 10,000, and then it crashes down to 8,500, which is still above current levels? Like, I don't know, but that's the sort of thing which can happen. Yeah, you get the crash, but from where? Sometimes it's much higher than where you anticipate. So you're better off jumping on board at some point, riding what trend you can get, using risk management like a stop loss or a trailing stop to get you out when the trend turns. That's the idea with having risk management, that you don't ride it all the way back down. You have a defined point where you say, okay, the market is, I've given it room to move. It's enough room, line in the sand. I'll protect my capital, move into cash, and I'll wait for the next round of momentum to come, whenever that may be, whether it be weeks or months or whatever. But yeah, sitting out waiting for crashes, it's often a losing game, because the market often does move on without you.
Yeah, it's good point once again. And most crashes, either coming for a really major event in the world, and I know the world isn't in the best shape. It never really is, really. But it's hard to think what the next. How are you ever going to know what the next major event is, right? So that's going to come. That's going to cause this crash once again. Some say it might be a bubble, could be, but then it's going to take a lot of people to exit out of the share market to absolutely make it crash out of this bubble. When we kind of work off the fact that in capitalism or the way we work is that. We're trying to grow. Everything's trying to grow, right? So everyone's trying to put their money into things that are growing, and it's hard to see what can happen in the future, right? But for now, everyone's really positive and everyone's really bullish, and the naysayers are unfortunately being proven wrong continually over the last few years, right? So, but anyway, it's good.
There's always something to worry about. There's always a reason to do nothing, and sometimes the worries will come, will unfold, and market will come back. But if we go on the basis that there's always something to worry about, and we put the Dow onto a weekly chart, so people have been worrying about stuff since. Well, I got into the market in 1991. I left uni, got my job at the investment bank. And people were worrying then about the recession during the late 80s, early 90s, after the 87 crash. People were worrying about the recession. It was going to come back, and it was things were going to get bad. And they've been worrying every year since. But look what's happened to the market during that period. Now, it's easy when you look at a weekly chart and you just see this big sweeping trend, and these pullbacks and these corrections and bear markets, which they sort of like pale in significance, but it's not to understate the pain they cause at the time. But the point I'm making is that there's always something to worry about, but look at over time, these big trends evolve, they grow, and markets crash, they stabilize, they recover, and the world continues on. So it's look, we can always be worrying, but you can worry yourself so much that that stops you from taking action. Take action, but manage risk. Manage risk is the key. You don't have to be right. You can buy something, you can fall, you can lose a bit of money, but just make it a bit. manage your risk, and go away and wait for the next setup, wait for the next trend, be patient, wait for things to line up, and then play. And if the game doesn't work, jump off, lose a little, wait for the next setup. But we can't see the future, so it's like dealing with what we have. We've got markets above moving averages, which are trending higher. Path of least resistance at this point is still up.
Beautiful. All right, let's have a look at the Hong Kong markets. That has broken into bullish, but it's starting to consolidate, I think.
Yeah, so this is interesting. Last week we spoke about the initial excitement and a bit of FOMO coming in as this market pulled away and got really stretched above the moving averages. And then, of course, surprise, surprise, it was followed by a sharp correction. And this is why we try avoid buying once markets get stretched above moving averages. The time to buy is when markets, get above the moving averages and show some momentum. We can look for opportunities around them, but when they get stretched, it's often best to stand back and just go, if I'm not in, I'm not in. I'm just going to wait now, because often you do get that sharp pullback. And it's typically just a matter of time before gravity kicks in and pulls these markets back towards the moving averages. And that's what's happened here. So we started seeing some signs of stability last week. That's continued over into the last few days. I think it's going to take more time before we get a clear idea of what's happening here. So this could be like another spike high like we saw during late 2022, early 2023, that then peaked and then started this long grinding decline all the way back down. So we couldn't rule out that something similar could happen there. You get a spike on excitement of the hope of government stimulus and the like, but then those hopes can sometimes fade and things come back down. I don't know which way this plays out. If this could also very much be the early stages of a new bullish phase. I think if that's going to be the case, if this is indeed the start of a new bullish phase, I'd expect to see prices start to find support above and around the moving averages. And if we start getting some sort of a platform develop or base develop around current levels, maybe that could set this up for another run. But I want to see that price action develop. I want to see the base develop, and then we can work around that. But if it's a continued grind lower, there's no need to play. It's got the initial move, got the initial pullback. Now let's just let the market show its hand as to how this is going to play out. Similar story over in China. Sharp rally, sharp pullback. The lack of support on the way down is a little bit concerning. It's the dip wasn't really enthusiastically bought. So like the trickiness around this is like a lot of this happened during the holiday period. So there's like this. So maybe that's accentuated the move higher, and maybe that's why we've got such a deep pullback. But the lack of enthusiasm to buy the dip is a cautionary flag. I think the key now is whether the market can stabilize probably around current levels. Buying of the dip should really start to underpin this market. And as I was saying with the Hong Kong market, we don't want to see this continue sliding back. For now, I think it's a case of just watching how the price action develops. There could be an opportunity setting up in this, but I don't think we're quite there yet. I think it's a case of just watching. Do we get stability near current levels? And then if we get stability, we get a platform. And then maybe we're looking at buying the next signs of momentum to the upside.
Yeah, and if you look at that as technically speaking, like it's sort of, the levels you're talking about hopefully will align with the EMAs as they start going sideways, as well as the previous peak there, right? So I think technically speaking, it's it's kind of gravitating towards those levels. But that's why I love the way you do things, Jason, because it does include a lot of patience. It's not just buying off that break and rebound. It's waiting to see it consolidate above those EMAs, and I've really taken on to that concept as well with all the share trading. So
like, do we see something like this develop over the next couple of months, and then from there you start to get the move higher? So the moving averages start to come along underneath. You get a bit of a base, and it starts to turn higher. But this could take several months for that to form, and I'm just guessing at price action. We often see price action like this, where a market sort of moves sideways into the moving averages, but we don't know. We don't know how this will play out. Different setups we can look for, but this is just one example. But that would potentially take a few months to build this basing structure, and then you start getting some momentum out of it, and we say, okay, look, we can buy this resurgence and momentum. We can have exit levels just below where the bottom of the base is, but these are just ideas around what could happen. We don't know. So it's a case for me at the moment, just watching how it develops. If nothing sets up which I feel is tradable, well, fine, just leave it alone. There'll be other ideas elsewhere. It's just wait for the good shots and take them when they're there, and leave the marginal stuff alone, and because the marginal stuff often just causes you frustration and costs money.
Beautiful. Thank you very much for a wrap up of those three markets. A couple of questions. First of all, did we send an email invitation? I'd have to check that, Graham. Maybe not. But just remember, you can always go on YouTube as well on our channel, and you can hit the little bell button notification, and it'll always, if you're on your phone or maybe the computer, it will actually notify. It will tell you when we're going live. I mean, that's another way to make sure you don't miss us, obviously. Matthew.
And the other thing, sorry, Rog, the other thing is if you're registered an interest with Motion Trader, you've asked for a free report or a free trial, I send out a reminder to my people that there's that we're going live at 12 o'clock, and I provide the link. So you can get it from a couple of sources, either maybe through Selfwealth or through me, or as Roger's saying, you go to YouTube. But come and register with Motion Trader, take out a free trial and see what I'm doing, and make sure you're getting this email each week.
Definitely. All right. Love the program, gents. Thank you, Matthew, and rating the moustache. Obviously, I will be supporting Movember coming up. I'm a big supporter of Movember, so I'm getting started early there. But thanks, Matthew. All right, let's start looking. Oh no, there is a couple of general questions we might jump on before we get to the tickers. All right. Do you sell as soon as the price hits the stop loss, or do you let it develop the next price action before taking a decision, Jason?
I'm not watching the price action develop. So once the stop loss is hit, it's like trade's over, and I'm getting out. This is say 98% of the time. There could be a couple of percent of special situations where something might have just happened. There could have been a brief spike for lower for some reason, which in the markets come straight back. There could be some special situations, but generally when a stop loss is hit or trailing stop is hit, I'm going to get out. I don't get out that very moment because I don't use a live stop in the market. I'll typically see which of my stocks have hit their exits through the day, and then I'll sell it maybe the next day or soon after. That way I might be able to manage my way out of it. I might, if I see the potential for a small rebound, I might try and finesse my exit, get out a little bit better. But you just want to be careful trying to finesse exits. If you try to get too clever, you can end up continuing to hold a stock which keeps declining. So if you want to finesse, I think you've got to then have the discipline to say, okay, when you get it wrong, that you just then bite the bullet and say, right, okay, I'll just have to cut it at a lower level, rather than just holding and hoping for a rebound, because that's when people can get themselves into a lot of bother and have stocks that then say, oh, now it's too late to sell, and the whole sorry tale of having a stock down 60% or more. That's kind of how it can all start. So for me, it's it's the trade is typically over once that stop is triggered. It's just a matter of how I then execute that sale. But I'm not watching, okay, look, now I'll watch it and I'm not doing this. I'm not saying, look, okay, it's been triggered. Now I'm going to watch it for a few days and see how it does, and I'll decide from there. The decision has been made. I'm exiting. It's just now a matter of me executing that exit.
Yeah, and I'm the same. I just like to keep it simple at the end of the day. Sometimes if I know that I'm not going to be available that next very morning to execute the trade, I will put on a stop loss in our system on Selfwealth. You can put a stop loss in there. If I know that the price is heading towards that stop loss set, I'll always put alerts in TradingView anyway to know if something's coming close to a stop loss. But yeah, the next morning I'm selling. I don't really. I just cut it, as you say, Jason. Otherwise, it starts becoming emotional potentially as well, right? So keep it simple. There's one more question. Do you incorporate the performance of specific sectors or themes into your weekly analysis to guide your trading decisions?
No, I'm just looking at the individual stocks. I just take an individual stock on its merits. I'll look at where its price is relative to its moving averages, what are its moving averages doing, and go accordingly. I'm not sector focused, although I do see themes emerging within a sector, which is interesting. But I'm not really doing anything with that knowledge. It's just out of interest to say, oh, look, I'm getting a lot of signals in property companies or gold companies or whatever it may be, or healthcare. But for me, it's the price action for the individual stock, which is what I'm focused on.
All right. So effectively, if you saw, materials are in the bearish phase on the general chart, it wouldn't matter for you. You would just get into any material-based company that's showing positive signs, price action, right?
If I'm getting the signal and that stock has, for whatever reason, etched out a positive setup, that's what I'm focused on.
All right, fantastic. Thanks for clearing that up. All right, let's start with some tickers here. We've got, starting off with Jacques on JLG.
So this has all come apart a bit. It's interesting. Like, I've got this big trading range. We drew this on at an earlier time. We would have been talking about this, and so this is involved with I think it's involved with strata management. There's been some negative publicity around that recently. Whether that's what's going on with this, I don't know. But I think that's the area which this company is involved with. We had this great uptrend, and then that went into the big consolidation. And big consolidations can lead to new upward periods, but you never know until you get the breakout from the range. As it turns out, in this case, it was a break to the downside. If I had this stock, I would have exited it. I would have been selling it on the breakdown. It's not a stock I'd be holding, even still with this rally back to the moving averages. If it was in my portfolio and I got stuck with it, with the this gap lower, and I didn't initially sell it, I'd be using the rally back to the moving averages as an opportunity to get out. It's a case for me at the moment, it'd be like sell the rally. Now, I've said that, of course, there is the possibility this stock continues to recover. And then someone would turn around and say, oh, well, hey, you said, you sell the rally, but look, it's recovered. Of course, that can happen, but it's not the stocks that rebound and go back to where they came from, like back up here to 560 or whatever. It's not the stocks that do that cause a problem. The problem are the stocks that rebound back to the moving averages and then sell down and make a new low, and then rally back to the averages and then come down and make a new low. And all of a sudden, you've gone from $6 to a stock which is now worth $2. Not predicting, there's no prediction in any of this. I'm not suggesting that's going to happen. It's sort of like more of a what if. So like, what if that were to happen? Are you comfortable with riding a stock for a 66% decline? If the answer is no, well, then you've got to take action to make sure that can't happen. The only way you can do that is by exiting at before that could happen. But of course, as soon as you do that, you give away the potential of a recovery. But for me, protecting downside is more important than holding on for a potential recovery. as it stands, we've got a stock which is trading below declining moving averages. So it's a vulnerable situation which could continue to deteriorate. If it starts to recover, well, great. I could look at getting back in at a higher level, but I'd be protecting capital. I wouldn't be buying it here on the prospect of getting a bargain, because I've got a stock which has just rebounded to declining moving averages. So that scenario I just painted before, it's not. I want to play stocks which are in a strong position, not a vulnerable position, and I think they're the ones with the highest probability of success. This is this is, for me, this appears to still be a vulnerable situation.
All right. CPU.
It's really not going anywhere much at the moment. There's a bit of an attempt to break higher in August, but didn't really get going. So if we were to look at this, look at it here, I would have said, look, it's trading along the moving averages. Maybe it's a case of buy the dip or buy the breakout. We could get another round of strength. This is how a setup can look. This is how we'd look at it if we were looking at it. If this was where we were now, but then the price actions developed, started to get this break higher. We had a sell-off which didn't gain traction, rallied back to a new high. It was all looking encouraging, and then it's fallen away again. So it's just a bit messy, this one. It's now below the moving averages, which have started to turn lower. I'd just be leaving this one alone. If I had it, I'd depending on where I got in, I'd exit it. If I'd bought this breakout in August, I'd probably just exit it, because it just hasn't played out. Buying a bit of a breakout didn't gain traction, fell back down. Initial fall below the moving averages, rebound to the averages. I'd go, look, it's not working out. I'll go elsewhere. But saying that, if I'd bought it all way back here in 21, and it's sort of more of a buy and hold situation, well, there's nothing to say change from that course. So where you got in is a determinant of what to do next. But as I just painted, if it was a relatively recent entry, I'd probably just move to another opportunity, because it's not doing much at the moment.
All right. The next one on our list today is CHN, and then you've got the straight after that. I'll let you guess what the next ticker after that one is.
Would it be PLS or MIN?
No, you're wrong, mate. We got one more chance at this. Do this one, and then I'll let you think about it.
Okay, well, let's have a look at this first. Oh, it must be APX, but it must be Appen.
Oh, you've got it exactly.
Okay, so Chalice. We're down in lithium rare earths worlds. That's where I was going with those other selections. It's one of those stocks which was a long time avoid for last year and into this year. Do we have like lithium's an interesting one at the moment. Is lithium bottoming out after a deep bear market? It's certainly a possibility. And Chalice was one of those ones which was a speculator's favourite. Back during 21 into the 22 peak, terrific gains were made from this stock. Look at this, from cents, 50 cents or so to $10. So it's a dream stock, but of course it hasn't been the dream in the last year or so. It's down 90% or something. Looking at it now, so it's crossed from below the averages to above. The averages have crossed, they've turned higher, prices above the averages. So we've got the building blocks of something going on here. It's now a case of how do you play it? If you happen to have bought earlier on, well, if I'd bought earlier on, I'd certainly be holding this now. I'd be staying with it to see whether this develops into something. and I'd be giving it plenty of room to move. I'd be giving it to at least to the probably the October low. Probably around. I'd be giving it to at least around maybe $1.50-ish thereabouts. So I'd be willing to give a bit back for the potential of something staying on something which could get a lot larger. May not, but it could. In terms of entry points, so let's just measure this out at current prices. Now, current prices, you need about 30% to put a stop below the 100-day moving average. So it's getting into the realms of what may be acceptable. I'd rather get it close to 25, but someone could say, look, I'm going to buy this little dip here and I'm going to put my stop below the 100-day moving average and I'll risk 30% because if I'm right and this really is a turning point for lithium, there's this dip gets supported and then in the next few months we're back at $4, you're up 100%. So that's 3 to 4 times the potential risk. So I think it's a stock of interest. It's one which is worth considering, particularly if you're comfortable with a bit more volatility and you've been watching this lithium story. This is the first time this stock has been for me in play since its long decline began back in 23 or whenever it was. So one to watch. Alternatively, just see whether we get some consolidation. We might get some narrow consolidation for a few weeks. Moving averages start to turn higher, then that could be the play. And then maybe the stop loss is a little bit closer. Maybe it is around 25% then. So a couple of ways to play it. Another way would be if we get consolidation and a breakout, buy the breakout. Various ways to do this. There's often not just one single way. We've got buying now, larger stop loss. We've got see how it consolidates. If we get the right consolidation, buying that or buying the breakout. Depends on what you want to do, but I think it's a stock where there could be. I think there's an opportunity to maybe make some money out of this one.
All right. Now I don't know if you've probably answered it here around lithium, but what are your thoughts on lithium? Do you believe the low to be in? That's a question from earlier.
Look, I don't know whether the low's in, but I think there's enough there to speculate upon a potential low. I keep an eye on this here. It's the Global X Lithium and Battery Tech ETF. It's a US listed ETF. It's we don't get a good price chart for lithium itself. So looking at this ETF of lithium based stocks is something I do. It's gone from below the averages to above the averages, turning higher. It's pulling back to the averages. So not dissimilar to what we spoke about with China, in that we've got the sharp rally and we've got the sharp pullback. Now, what's going to happen to the averages? Do we get stability? And does that create the opportunity? Going through looking at the local ASX lithium stocks for ideas as well. What are the setups like? I think there's a tradable. I think there's a tradable play here. It just depends how you want to do it. And that doesn't mean that we're going to make money from it. It just means that we can see a setup which has the potential to deliver a multiple of our potential risk. So they're the setups I like to play. For those who like lithium, I think now's the time to be looking at this closely and monitoring your stocks.
Beautiful. All right. Well, let's get on to our fan favorite, APX.
So we're getting a bit of that pullback. I think this is what we would have been saying. I would have been saying last week. It would have been we're a bit stretched above the averages. I want to wait for the next consolidation, see how it looks. So we're getting the consolidation now. I'd be inclined to continue watching for a bit more because, there's all sorts of ways this can play out. We could get a zigzag sort of consolidation could start to play out. We'll get a bit of initial buy the dip, and then there's another sell off, and moving averages keep coming up. If I'm in it, I'm happy to stay in it and just use a wide trailing stop, probably below the 100-day moving average. I like to keep them really wide because I want to give it every chance of staying in. If you set tight stops, like, look at this. This is a, what was that? That was a 40%. That's a 44% pullback there. So if you're using a 20% stop loss, you're going to get knocked out. And then it finds support above the 50-day moving average, and it goes again. So that's why I'm using these wide trailing stops, which are calculated using a stock's average trading range. So it's volatility based. So I'd be doing the same here. My stop would be back down here, at least below the 50-day, probably below the 100-day. Give it lots of room, because I'm not trying to get this initial rally. I'm trying to get stocks which rally and rally and rally and go up several 100%. It's like, not all stocks, most stocks won't do that, but you only need a few, but you only get them if you stay with them. So that's my goal here. If I was in it, I'd be giving it plenty of room to move around. I'd be staying in. If I'm not in, I'm watching it still and see how this pullback plays out. It could give us some nice clear-cut levels to play it, in terms of like buying the dip with where to exit, or buying a breakout. For me, a little bit, let it develop. Be patient. A little bit more price development, and sometimes it'll just turn and run again, and someone will say, "Oh, look, you're too slow. You waited too long," and it will happen. Of course, that's going to happen. But I'm waiting for the right setups. I'm not just looking to play at anything. It's I want to wait for it to everything to sort of like line up, and then it's like, okay, this is the one. Until I get that, I'll just sit on the side and watch.
All right, RTH.
Yeah, not much. The problem with this stock is there's just so little. There's not much volume in it, and the bid and offer are often quite apart. There is an uptrend in play. I had this stock myself. I can't remember exactly where I got in. Maybe it was around February, because I think I got this move higher through March, and that was all looking good. But then this pullback was deep enough to hit my wide trailing stop, and I was out. Now, of course, it's bottomed and it's gone back up, but that's okay, because that's going to happen sometimes. It's we spoke about this earlier. My concern is that I don't get stopped out and I sit there hoping for a rebound and it continues on down. That's unacceptable. So I use my stop loss and I get out. So now it's rallied again. So we've got this broad upward trend in it, but the problem with playing it is you've got to be really comfortable with not having much liquidity. I've actually had another buy signal myself to get back into it. It's a motion trader stock. I got a signal for myself to buy it. I haven't bought it. I've looked at it a few times. I keep looking at the liquidity, just going, I just don't like the lack of liquidity. I just don't want to get stuck in something which is just a pain to get out of. So there's a trend there. It's come back to the moving averages. If it was in my portfolio, if I had got back in, it was my portfolio, I'd be happy to keep it there for now, because we do have that trend. I'm not in a hurry to buy it because, those reasons I talk about liquidity. I think it's a difficult one, but it's involved with betting, online betting. I think, so I had a look at what they did, because sometimes, like, I'm not focused on the fundamentals, but occasionally with these stocks which have technology in the name, I'll go, look, is it a stock which the market could get excited about? Is it a stock that could double, treble, quadruple? And because if that's the case, I really need to probably have something on board. And it's, look, anything to do with technology, maybe, but maybe I was less excited about. I don't know the industry, so I won't go down there. So look, it's a hold if someone had it, but I think it's a tricky one to buy.
Let's go. Thanks for your honesty, Jason. At the end of the day, there's plenty of opportunities out there, right? So LYN.
Well, this is it's only been listed since around 2022. We've got this nice contracting trading range. I'd be I wouldn't be a buyer here. I'd be wanting to buy a breakout to the top side, particularly being a smaller cap resource play. These stocks can also, just break back down and, just continue to fall away and do nothing. Like this stock has never been in an uptrend, and may never be. Of course we don't know. So for me, I'd probably be looking at the October 11th October high, maybe a break above there, or the September high. One of these two. Like maybe we could say, look, it's a buy at 36 cents, and then it would be so we're buying a breakout to a new high, and then have maybe a 20% stop loss on it, just back to the 50-day moving average. So I'm buying this one into strength and buying a breakout from this contracting trading range. The risk at the moment is, we get a break to the downside. We're getting pretty close to the lower end of the range. If we use this trend line as the measure of that, you could also, if you didn't want to use the trend line, you could use the September low. If someone really liked it for some reason and they wanted to take a higher risk approach, it could be bought at current levels with a close stop loss. You need to check on whether the volume is liquid enough to do this, but a stop loss could be placed. Look, even still, it's still looking like a 14% stop loss. I'm just not comfortable buying this into any sort of downward momentum, because I'm guessing it's going to be relatively thin, just given the patchiness of the chart. I'd rather buy a breakout to the top side. I think that's probably the play with this one.
All right, WGN.
Yeah, lovely breakout. And here's the pattern we talk about so often: from below the moving averages to above, the sideways consolidation into the averages, and then the breakout. This is it almost called textbook in terms of like what we like to look for. You can see it again here: below the moving averages, above, consolidating into the averages, and then we got the uptrend engaged. That's the sort of stuff I'm looking for, and that's what I'm looking for on Appen. We've had it's different. The structure is different, but it's the same principle. Just giving it time to consolidate and base, and then once we have that, we've got a clear levels to work with. So if I had this one, I'd continue holding it. I'm probably not a buy here, because I think, where am I going to put my stop? Oh, look, no. I think it's probably getting a bit stretched above the averages. I think there's a good chance it's going to consolidate. I'd rather probably wait for the next consolidation to be a buyer. But in terms of if I had it, I'm more than happy holding this one and seeing where it goes. We never know where these stocks are going to go. Some of these breakouts go a long way, others fizzle, and we'll only know later on. But it's got the potential. That's the key. We're getting on stocks with the potential to do great things for the portfolio, and I'd be giving this one every chance to see what it can do.
All right. So we'll just move on to the other ones, Matthew, other people's on the show. And if we've got time, we'll circle back to the other ones just to give them a bit of a chance as well. AMA, please.
Maybe. Look, there's it has emerging trend potential with it, in that it's come from great heights. It's been down and out for a while. It's really been just grinding along the bottom over the last year or so. But now it's gone from below the averages to above. We're getting this sort of sideways movement near the moving averages. So there's certainly potential with this one. It could be, if someone wanted to speculate on it, probably could be bought at current levels, have a relatively, it's only a 6 cent stock. So the percentages are always a bit different with these ones. It could be bought at current levels with say an 18 to 20% stop maybe, and it's asymmetric, because it's like gets to 10 cents and it's up 60%. So it justifies sort of like that 20% stop loss. Alternatively, buy a breakout to new highs. Maybe you're looking at like 6.8 and then having a stop below the 50-day moving average. But bear in mind, these stocks, this could just be like oscillating either side of the moving averages and just grinding along the bottom, might not go anywhere. But if you think it might go somewhere for some reason and you want to play it, well, they're the ways probably to do it. But everything that goes down doesn't always go back up. Don't know what's going to happen with this one, but there's some ways to play it.
All right, VUL.
Trend is we've got the makings of a trend here. I think we must have spoken about this last week, and I've drawn in these lines where we got the breakout, had this initial run away from the moving averages, but getting the consolidation. So this could be like the buy the dip opportunity. What we're getting at the moment, we're getting this little pause, we're getting this dip, 15% stop loss back below the 100-day moving average. So I'd be inclined to say, look, is it a matter of couple of ways? Oh, there's more than a couple of ways. Buy it at current levels now with a stop below the 100-day moving average, 15%. Watch how it consolidates. Maybe buy as the moving averages come up, but it still could be around current levels, or then you're buying a breakout. If we get consolidation, then buying a breakout. If this was on my buy list, I'd probably consider even maybe getting half a position now, just in case it shoots higher and doesn't give much consolidation. Just because I know the risk is only 15%, and it could be one of those stocks where you can sort of like see the potential for it, having a good run. Worst case for me would be saying, look, I need to buy this stock. I'm just going to watch it consolidate. Then it quickly jumps to 550. And then I'm going, well, now what am I going to do? I haven't bought any. It's 550. Now it seems like it's pulled away and a bit stretched. I'll wait for the next consolidation. Then next it's up to $6. So you can see how you can chase your tail sometimes in these. So if I wanted to buy this one, I'd be inclined to get some on board now.
Okay, fantastic. WTC.
So this triggered its motion trader trailing stops yesterday. It had been a nice trend. So I think the initial signals must have been back around February when we cycled from below the averages to above. Yet again, there's that sideways movement into the averages. Then we started to get the breakout. That was probably the entry point. Wide trailing stops will only get you so far. There's going to be times where the market does gap lower, and it's unexpected as well. Like, you usually don't expect a stock which is trading at all-time highs to fall 26% in 2-3 weeks. But it can happen. It's a stock market, so we should always be ready for the unexpected or surprise things to happen. This is why we spread risk. Many relatively small trades, not big, high concentrated bets, because that can lead to trouble when you do get these stocks trading at highs just rapidly falling. And of course, it's news related. That's why we've got the gap lower. It has taken the market very much by surprise. So for me, it's an exit. If I had some, I'd probably be inclined just to cut it. Like, there's one side that says, oh, look, maybe it's a bit overdone. Maybe we get a little bit of a rebound. I could sell into that. But we could just as soon just get another move back down at the lows. So it's almost like a 50-50. So I'd be inclined just to cut it and move on, and hopefully to have banked a reasonable trend in the process, although it's had a disappointing and rapid end.
All right. WTM.
If I got the right code.
M for Mary.
M, there we go. It's going to change it a bit. Yeah. Look, don't really have a strong feel on this one, in that I guess my thoughts are this: it looks like it might consolidate for longer after this big initial rally. So if I was in this one from lower levels, I'd be happy to stay in it and just see what it does. Give it plenty of room to move around. So my stop could be maybe back down around 20, 22 cents or something. I'd be giving it lots of room to let it maybe track sideways, and then from there it could get another run higher. But these low cap mining stocks, you just don't know. Some of them can really go on to huge gains, but others just they spike higher and then they make their way all the way back down. So I think managing risk is essential with it. I'd be giving it lots of room, but making sure I've got an exit plan in case it's one of those ones that makes its way all the way back down. In terms of buying it, I'd want to see the price action develop. I don't see a trade I want to play at the moment.
All right, we'll do the final three from Matthew here. FID.
Yeah, look, there's an uptrend in play here. This is a definite hold for me. It's also a potential buy as well, probably, because it does seem to be like we're getting it's stepping high, strong move, pull back to the averages, strong move, corrective looking pullback to the averages, and now it seems to be breaking again. 15% stop loss back below the 100-day moving average. It's at towards, I think this is all-time highs, but who knows? Who knows how far all-time highs can go? Momentum is very much to the upside. It's encouraging. It's holding in well today with the All Ords, or with the ASX 200 pulling back as well. So it's I think this is one I'd want to continue holding.
All right. BIO.
I like this pullback. It's very much a corrective looking pullback. You can see how the up move is impulsive in that it moves higher with not many pullbacks, and then this pullback we're seeing, you can see how it's choppy and it's overlapping, and it isn't making much headway on the downside compared to what was happening on the upside. So this is a stock I'd be continuing to hold if I had it. It's a pullback to the 50-day moving average, just sitting on the moving averages. Maybe it could even be a buy on a breakout back above. Maybe it's back above the October highs. That could be a buy point. It could be a buy the dip where it currently is. Then stop loss is back below the 100-day moving average. So a few different plays depending on what one's looking at. But there's the potential for this trend to go further.
All right, and then the final one, SGI.
Similar to what we just looked at, in that we've got the impulsive rally, and that looks like a corrective pullback. This has been a motion trader stock. I'm pretty sure it's still in there. I think it still is a motion trader stock. Consolidating back towards the moving averages. This is, look, it's a less actively traded stock. Liquidity's on the low side. But if you're comfortable with that, also the possibility of buying the dip close to the 50-day moving average, and the stop loss is where would that be? Look, stop loss could be below the 100-day moving average. It's I think it's manageable based on the potential upside. So one to hold, one to consider if you like the sort of industry and you're comfortable with the low liquidity situation the stock has.
All right, beautiful. Thank you very much, Jason. I think we'll wrap it up there. Thank you for another wonderful show with lots of insights and the ability for us to analyze the price charts and the markets in general. Don't forget, if you would like to, please like and subscribe to our channel, YouTube channel, and then leave us a nice comment, obviously. Leave my mustache out of it. That'd be great. Maybe Jason's going to join me in November with his mustache. He said, how long does it say before you can grow one, Jace? We need more lead-in time.
Oh, I need a longer runway. I've got to start back in June. It's too late for this year. Can start planning next year.
All right, we'll start planning for next year. Go check out Jason and his lack of mustache over at motiontrader.com.au, and you can check me out over at Roger. You can just say hello, send us a line, message me, and I'm sure I'll answer you at Selfwealth. If you have any questions around the platform, obviously that's what I'm here to do, to help. So if you're not a member or a client, you can sign up at selfwealth.com.au. All the links will be below, obviously. And other than that, just remember, obviously, everything we do or say here is general advice. So make sure you do your own research on the stocks that you want to buy or sell. Thanks, guys. Thanks, Jason. And we will see you again next week. Thanks, everyone, for coming. Take care.